Okay, we are done with money and its concept. Now let's move into banking system of India. Okay, one note here that we are going a little bit faster since this is mainly to help you revise and consolidate the concepts and the fundamentals in a faster manner. So what is bank? A bank, it is nothing but it is a financial institution in the economy which will accept all the savings or all the deposit. It helps in giving loan to the people who are in need. It helps in credit creation. So this is what is the main banking function in India. How did banking system evolve in India? Is it only after the British that bank evolved in India? No, banking system was prevalent in India ever since Vedic time. But first bank as such as a financial system was set up in Madras by the East India Company in 1683. And if a bank which was set up or which was first Indian owned bank is Allahabad Bank, which was set up in 1865. Coming to one major bank of India, that is Reserve Bank of India, or what is known as RBI. Why was RBI formed? During 1930s there was crisis, that is Great Depression, which caused all the small banks to fail. In order to fix this, RBI Act of 1934 was enacted, and resulting which RBI was formed in 1935. Headquarters of RBI was set up in Calcutta, which is now shifted to Mumbai after its nationalization in 1949. Nationalization means RBI initially was a private company which was taken over by the government in 1949. So this is how the RBI was evolved. Now what are the major functions of RBI? RBI performs two different functions, monetary functions as well as non-monetary functions. So what are them? Let's study them. Monetary functions, which we have already studied, is that RBI is the issuer of currency in India, except for the coins as well as 1 rupee note. Everything else is issued by RBI. Then RBI is a banker to government. Let's put a star mark to this, because if this is in current affairs, we'll study it later. So whenever government needs money, it RBI is an institute which issues money to the government. It is not only a banker to government, it is also the banker to bank. So all the banks, if require money, go to RBI for help. Then RBI is also responsible for managing the foreign exchange. All the dollars, currency, different countries' currency is managed by RBI. And other monetary function of RBI is it helps in controlling the credit formation within the Indian economy, that it fixes CRR, SLR, etc. And this monetary transmission helps in credit formation within the society. And what are the non-monetary functions of RBI? RBI has a regulatory as well as supervisory role for all the other banks in India. It acts as a teacher or principal for all the different banks in India, maybe SBI, HDFC, etc. It is a principal for all different banks. Then it helps in development and promotion of the economy. And other function includes it collects various data and releases different reports. Example include financial inclusion index or digital payment index, or all the reports which are released by RBI. So these are the various roles of RBI. Now what are the liabilities and what are the assets of RBI? Liabilities majorly include the loans, and assets majorly include the loans which RBI has given to the different banks, because it will get it in the later phase. So it is a asset. And liabilities majorly include the currency which is present in the public, because all the notes in your pocket has whose signature? RBI governor signature. So he is responsible for you to give that much amount of value for the currency you hold. So this is majorly the liabilities and assets of RBI. Coming to the banking system as such in India. The banking system in India can be divided into scheduled banks and non-scheduled banks. So what are the scheduled banks and non-scheduled banks? Scheduled, okay, before this let's just know two different acts. One act already we studied, that is RBI Act of 1934, through which RBI itself was formed. The other act is Banking Regulation Act 1949, which is responsible for different regulations of banks in India. So now coming to the scheduled banks and non-scheduled banks. Scheduled banks are those banks which are included in the second schedule of RBI Act of 1934. So in the RBI Act, there is a second schedule. All the banks which are present in this second schedule constitute scheduled commercial banks. So if a bank must be present in the scheduled commercial banks, what are the criteria or what it must have? So these banks, first of all, must have a paid up capital or reserves of up to more than 5 lakh rupees, and they must maintain CRR. What is CRR? Cash reserve ratio. That is some amount of money they have to give to RBI, because RBI is the principal, right? So banks have to give some amount of money to the RBI, which helps them regulate themselves, or which is acting as a safety for the banks itself. And in return, RBI will help in giving loans to these banks when in need, or these banks also get the membership of clearing house. So this is what is scheduled banks in India. The scheduled banks in India are further divided into commercial scheduled banks, regional rural banks, and cooperative banks. The scheduled commercial banks again are of three different types. First one is public sector commercial scheduled banks. These are those banks where government stake is major, include SBI or all the different nationalized banks of India are public sector banks. What are private sector banks? These are those banks where private sector holds a major stake. These include ICICI, HDFC, etc. And there are also foreign banks. These are those banks whose headquarters are present in their own country, but the branches are present in India, which was allowed after liberalization in 1990s. So these are three different types of commercial scheduled bank. The word commercial means these are mainly set up with the motto of having profit, but public sector commercial banks also has different welfare intention too. Coming to regional rural banks. What are these regional rural banks? Okay, regional rural banks are set up. Okay, let's study here. Regional rural banks are set up under the Act of Regional Rural Bank Act 1976, like scheduled commercial banks under Schedule 2nd of RBI. RRB as a separate act. Okay, now here the major stakeholders are divided into three different units. Public sector or government banks has a union government has a major stakeholder with 51%, and state government has 15%, and any sponsor bank will be the remaining 35% stakes in a regional rural bank. And what is this region means it is for a localized area, and what is rural, it is mainly for rural areas or even semi urban areas, so that the banking activity spread to rural areas and there will be financial inclusion within the Indian economy. But there are some different things in RRBs. Okay, they have to keep CRR, they have to have SLR, everything is same. But priority sector lending for regional rural banks is 75%. We'll study what is priority sector lending in later phases, but for now it is that certain sectors will be getting loans majority, that is 75%. And in regional rural bank, if the director or principal is RBI, there is also headmaster to this, that is NABARD, which is a financial institute of Indian government. So if regulator is RBI, immediate regulator includes NABARD. So this is about regional rural banks. Okay, now we studied about private banks. Who can establish private banks in India? Can I go and establish a private bank, or can you go and establish a private bank? So there are some criteria for who can establish a private bank. There is an on-tap licensing which is given, but mandate includes that person must be resident Indian individual and he must have minimum 10 years of experience working in non-banking finance company, and minimum paid up capital now, thank god, initially it was only 2 lakh for scheduled commercial bank because it was in RBI Act. Now it is minimum 500 crore capital, so they will get on tap licensing. But what if I and you have to set up a company, set up a bank, then is there a provision? Yes, that is cooperative bank, which is also a scheduled commercial bank in India. So what is cooperative banking? So this works on the principle of one person, one vote, or the principle of democracy, where group of people save together, save their money to form bank, and they lend among themselves when they are in need. Now we know cooperative comes under state subject, whereas banking comes under union subject. So who should regulate this cooperative banking? In order to understand this, all the management aspects, that is administration of the banks, such things are controlled by state, whereas all the banking functions, that is controlling credit, controlling finance, is controlled by the central government, or in other words it is controlled by RBI, and this is controlled by state, since these cooperatives are registered under State Cooperatives Act. So they are also controlled by state. These are of two types depending upon the areas where they are present: rural cooperatives banks and urban cooperative banks. Urban cooperative banks are registered under the State Cooperative Societies Act and they are regulated by RBI. All the banking activities are regulated by RBI, whereas the other management activities are regulated or managed by Registrar of the Cooperative Societies of the state. Similar to RRBs, where principal is RBI, headmaster is NABARD. Here there are two different things. RBI is the regulator for the banking activities and all the management aspects are regulated by Registrar of cooperative societies. Now what about rural cooperatives? Rural cooperatives, first they are at a different level or different strata. If the cooperative societies is giving loan for short term or mainly for agricultural loan, then it is of three different strata. At the grassroots level or at the village level, it is primary agricultural credit societies, that is PSES. At the district level, it is district central cooperative banks, and at the state level, it is state cooperative banks. If the loans are given for long term, that is for infrastructure development or mechanization, and it is of only two different levels. At the state level, it is SCADs, that is state cooperative agriculture and rural development banks, and at the district or the block level, it is PCADs, that is primary cooperative agriculture and rural development banks. So this is about cooperative banks in India and their regulations. Now other different banks in India. Okay, development banks. This includes all those banks which provide heavy loans or large loans for different purposes of development. There is NABARD, mainly for agriculture, SIDB, that is for small industries, which means MSME, EXIM, which is mainly for export and import. We'll study this later during financial institutions. Then there are other banks, that is differential banks. These differential banks were formed after the recommendation of Nachiket More committees, and these are of two different types: payment banks and small finance banks. Okay, let's study here somewhere. Okay, payment banks and small finance bank, both of them are differential banks. So what are payment banks? These are those banks which have restricted banking function. What is restricted banking function means? That they cannot perform every function of a bank. Means they will accept deposit. Obviously these payment banks, if you go and deposit, they will accept the deposit. Then what, can they accept payments? Yes, they can accept payments. Can they accept remittances? Yes, definitely they can even accept remittances. Then what can they not do? They cannot give loans. So this is what is payment banks. This include all banks such as Airtel banks, etc. So if they cannot give loans, they cannot give credit cards, but they can give debit cards. So this is what is payment bank, and even they can accept only 2 lakh rupees per customer. So this is about payment banks. So what are these small finance bank? Small finance banks, they were established mainly to provide banking functions to unserved sections, including small and marginal farmers, MSMEs, or organized sectors, etc. They can accept deposits, they can even give loans, they can even have their own ATM. So they can give credit cards, they can give debit cards, they can give loans. Everything is same, and both of them are again regulated by RBI. But minimum paid up capital for payment banks is 100 crore, whereas minimum payment capital for SFCs is 200 crore. What difference again is the priority sector lending for payment banks is 75%, and priority sector lending for SFB is also 75%. Sorry, here payment banks doesn't, because they does not give loan, priority sector doesn't come here. Okay. Priority sector lending for SFB is 75%, which recently was reduced to 60% in this year. So this is a current affairs which we have to know. And one more current affairs which we have to know is RBI transferred around 2.5 lakh crore to the government in 2025 on the basis of economic capital framework, which was set up by Bimal Jalan Committee under RBI Act of 1934. So what is this economic capital framework, and why did RBI transfer it to the government? So economic capital framework is a rule book of how much should RBI transfer the money to the government. So that is economic capital framework in simple words, because initially there was no rule book and there was always a tussle between RBI and government on amount of money which has to be transferred between them. So Bimal Jalan Committee came up with a solution, that is economic capital framework based transfer, that was around 5.5 to 6.5% rule. So they told there are two types of capital. One capital is realized equity, the other capital is revaluation balances. So realized equity includes the actual cash profit which is made by RBI, that is the contingent risk buffer, which is the actual cash which is profit earned by the RBI, and revaluation balances are those paper gains. Matlab means they have not actually earned this profit, but still there is a profit. That means if gold RBI holds becomes more valuable, so it is a profit, but they haven't sold this gold yet, so it is on paper profits. Such profits are known as re-evaluation balances. So this Bimal Jalan Committee told that if realized equity should be kept between 5.5 to 6.5% of the RBI's total balance sheet, and if it goes above 6.5%, the excess should be transferred to the government. Since RBI has made profit more than 6.5 or more than 7.5%, 2.69 or 2.7 lakh crore were transferred from RBI to government. So this is about banking structure in India.